Hello, welcome to another module of the Optimum Academy. I'm Lisa Berger, and today we're going to be talking about the basics of business coverage. Some of the things we're going to be talking about is an insurable interest, the purpose of the coverage, and the types of businesses that use this coverage. Similar to personal coverage, business coverage also requires that there be an insurable interest. In business relationships, the death of a key individual in the business would result in financial loss or disruption of the business operations. Employers, they have an insurable interest in the lives of their key employees, and in business partners, they have insurable interest in each other's lives. Normally, it takes all of the partners to keep the business going. They'll bring something different to the table. In the case of creditors and debtors, the insurable interest lies in the lives of the debtors if the debtor's death would impact the repayment of the loan. So they're basically protecting the loan repayment with this type of coverage. A common type of insurance coverage is buy-sell. So that's the purpose. The company owners are insuring their ownership percentage to keep the business a going concern at the insured's death. There's a couple different types. If the owner and the Benny is a business, it's a typical buy-sell. And there are some that they'll do a cross-purchase, where the owner and Benny is the business partner or partners. This can get kind of convoluted when you've got more than two business partners because the number of policies increases. But there are situations where that makes sense. And basically, the business value is whatever percentage the insured owns, that's their portion of it. They don't have insurance for the entire amount of the business, just their piece of it. So the more partners there are, the smaller the piece of the puzzle is for them individually, and that's what we can justify. So as an example, if we have two business partners and they each own half of a company that's valued at $2 million, we wouldn't insure both partners for the $2 million. We would insure them for their half, which is $1 million, with the other partner's beneficiary, and that would be a normal type of a buy-sell coverage plan that would go into place. Basically, this allows the surviving partner to continue with the business. Buys them out, they can find somebody to do different portions of the work that they can or are unable to do themselves. But it keeps the business a going concern at the early demise of one of the partners. Another type of coverage is key person. This covers the loss of a key staff member in the event of their premature death. It's normally about 5 to 10 times salary. The key here is to make sure that they are key to the business. If it's a janitor, that's a position that's easily replaced. If it's somebody that is very special to the business and holds knowledge or they have abilities that others don't normally find that they have in the industry, it would take longer to find a replacement for that person. So an example would be if there's a scientist that created some secret formula for one of the pharmaceutical companies. That person would be key to the organization. They're the ones that they created the compound or substance or whatever is used, and probably the patent might be held by the company, but the person was the brains behind it, and their loss prior to a normal age of retirement would create a problem and a loss for the company at that time, and that's what the key business coverage is for, or key person. The other purpose that we find is for loans. Normally, you can go up to 100% of the insured's portion of the loan. So, going back to what we talked about before, we can only do whatever the loan is or whatever the business is, the key, the buy-sell coverage. The business value is only based on that person's percentage of ownership. So, as an example, if there are 5 partners in a business that each own 20% and the loan is $1 million, each individual person would be maxed out for their 20% of that loan at $200,000. We wouldn't give each of them $1 million, because for a $1 million loan, if we did that, it would be worth $5 million. Well, at that point, they're better off dead than alive for the person that or the entity that provided the loan coverage, and we don't want that to be the case. We want them to be whole. So each person is only responsible for their particular share. Now, covering different business types goes from the most common and the easiest to the most complex. So you have sole proprietors, closely held businesses, partnerships, different types of corporations with CNS, LLCs, limited liability holding companies, and then regular holding companies that encompass, multiple businesses. With the sole proprietorship, it is owned by one person. That person is personally liable for business debts. It's easy, it's inexpensive to establish. Normally, the purpose of the coverage would go back to key person or loan, and that's probably what you're going to see most often. In these situations, kind of blur the lines between what's personal and what's business coverage. So you might have an opportunity to see them as, an income multiple replacement, for the family, a key person because they're the only ones in the business. And there could be loans outstanding, both for the home and for the business. So in these situations, there's an opportunity to offer different types of insurance, and they are additive in nature for these. So something to be mindful of. A closely held business is one of the types of a sole proprietorship. Again, it's a combination of business and personal coverage. You usually see these with farms, family businesses, or those that are self-employed. And most of the ownership is with a small group, privately owned, a small family, something of that nature. And we use a combination of the income replacement, key person, buy-sell, loan, estate conservation. All of those can make sense depending on the circumstances. So just finding out what the details are and breaking it down really helps. An example would be a 40-year-old male with an income of $200,000. Maybe he's an orthodontist in private practice. For his income replacement, we can do 25 times his $200,000 or $5 million. For the net worth, he's worth $10 million. And for whole life, we'd use 1.5 time multiplier at $15 million justified. For key person, 10 times 200,000 would be $2 million. And maybe he has a business loan of $1 million. He has 100% of it himself. There are no partners. So we'd do 100% of that loan. And the fair market value of his business is $15 million. In this type of a situation, we can justify quite a bit collectively with this. Up to maybe $38 million with all of these. So really the key when you've got something that's complex and things kind of blur the lines, just writing down the different sections for yourself on what is he really trying to protect and how is he trying to do that and can you justify it. Another business type are partnerships. So it's usually by 2 or more people. They are personally liable for the company debts, similar to the sole proprietorship, and they share in the profits and loss. A couple different types are general partnership, where all the partners share equally. There are also limited partnerships. So it's a combination of general and limited partners, and those limited partners have a limited liability. Some of the purposes of coverage in this situation would be, buy, sell, loan, key person, or a combination of the 3. And again, a lot of these are going to fall under the closely held business that we just talked about, where there might be some personal coverage there as well, and it might get a little blurry. Another business type is a C corporation. This is a legal entity that's separate from the owners. The ones we've talked about so far, the owner and the entity are treated one and the same. They were all personally liable. In a corporation, that legal entity being separate, they have limited liabilities for on a personal level for business debts and obligations. The business is the one, since they're a separate entity, the business is responsible for the debts. So those that set up the LLC have limited their liabilities in these situations. These corporations can issue stock in order to raise capital. The downfall in these is that they're a little bit more complex. than the other ones we talked about, and they are costly to establish and to maintain. In these situations, the type of insurance that they will normally ask for would be key person or loan coverage. Those will be pretty common for these. Now, there's also an S corporation. It's named from the subchapter S from the IRS code, and it offers some tax advantages with limited liability protection. So the taxes pass through the entity to the shareholders' tax returns on a personal basis. The benefit is that the corporation isn't taxed at the higher corporate rates like a C corporation would be. And like a C corporation, the shareholders' personal assets are protected from corporate liabilities. So the liability is limited to the amount of their investment in the company. And that's where the limited piece comes from it on that. Normally, again, you'll see key person or loan coverage as common reasons for coverage. In an LLC, a limited liability coverage company, the owner's assets are protected from the business liability. And they can be taxed either way, either as a partnership or as a corporation. But again, when it comes to insurance coverage, key person or loan coverage are the most commonly seen. One of the more complex types of business is a holding company. Their primary purpose is to own and control other companies, which are their subsidiaries. When you're looking at coverage in these types of situations, each subsidiary needs to be reviewed as the business type and the parties can vary greatly. They won't have the same owners. They will not have the same structure. So looking at them individually makes the most sense here. These, again, are the most complex. And again, key person or loan coverage is usually the most commonly seen insurance. So while most of what you see is going to be one purpose, you could see a combination. The basic tenets are, is there insurable interest? If there is, what is it? If there is a clear purpose, whether it's single or multiple reasons, dividing those out and documenting your file that way will help you to break that down. And knowing the type of company can guide you into the type of coverage that is intended. Sometimes they'll misspeak on the application and they'll say it's key person when it's really buy-sell. So you kind of have to help the agent along with that. And as with anything else in underwriting, the key question is, does it make sense? So I want to thank you for joining us today. We appreciate you spending time with us. If there are other topics you'd like us to cover, please just drop us a line and let us know. We'd be happy to do that. Thank you so much. Bye-bye.